Well, then we got the second most common objection that we hear, that if you had a full reserve banking situation where the bank wasn't able to create $10, or the banking system wasn't able to create $10 worth of credit money out of $1 in deposits, that the banks wouldn't have enough money to lend out, that the banks, rather than creating the money out of nothing, okay, and paying no interest on the money, would have to pay a depositor some percentage, because it would be real money deposited that they're lending out. Wouldn't interest rates to borrowers be higher under a debt-free, full reserve banking system?
Right, right. Now, there's two parts of that you mentioned there, Pete. One is the amount of money that's there, and again, if the premise is that in either case there's the same amount of money going to be there, then there's an ample amount of money. There's an ample amount of new money created. So there's no shortage. There's really no shortage of money created, okay? And we've created the money as equity, okay, so that it's there. Now the point about well, they would have to pay because the depositors would get money. Well, for first of all, a large proportion, Pete, of the population that uses checking accounts primarily, okay, their money flows in and out through their checking account. They don't get, nor would they get, a return, an interest payment on that, because it's demand money. It's demand money. So that part's eliminated. For the people, for the percentage of the people for whom savings are going to be lent out now, and that I think is a big part of it. Some people, that's no different from now. That's no different from now, because when the banks create a debt and lend money into existence, that money gets deposited. That's basically what that loan is. That loan is now it might go into a different bank, and that bank doesn't have to pay interest on it, but you have to look at the system as a whole, so that the money that's created right now through debt gets deposited and becomes a requirement. There's a requirement there to whatever degree to pay interest on it. As a matter of fact, it's a greater requirement because all of the money is created as a debt. You've got the debt service payment that's due, so that's creating a future obligation, and at least equally is the base, which is to say all money is deposited. And if all money is deposited now, no different from if you did it on a debt-free money basis. So there's either the same pressure, Pete, okay, for interest rates to be what they are, or lesser pressure, because we've created a surplus of money, is what we've done. We've created money as equity. We've created money, and we're either going to make it available in savings to be lent and money to be collected on it, or it's going to go into the checking account, in which case it will create no
won't be lent out.
Will not be lent out.
It won't count towards any reserves for any lending.
Right. So there's two things about it then. A, there's adequate money. Adequate money, that the thing that goes to is the demand for loans will be met. Adequate money exists. The demand for loans will be met, just like it's met right now. In fact, to a greater degree, because we're not taking out of any future years, the money that has to go to pay the interest on creating the money. So really, there's not any reason to believe. And if you read, Pete, the history books, finance, this is the economic textbook right here, 101. And read what Irving Fisher, had to say about why.
What's that book you're pointing out there, John?
Well, this one here just happens to be Money and Economic Activity Readings in Money and Banking, which is, one of the economics textbooks. But in there, Irving Fisher lays out why full reserve banking is anti-inflationary, anti the pro-cyclical, booms and busts, anti-deflationary. Why monetary stability is a result of it. And if this is the stuff that they're teaching in the textbooks, then there's, it has to be real. That is to say, has to be part of the reality of it. That doesn't mean that people don't argue against it, of course, because the reason we have the system we have now is because people argue against it, and they win. And the winners get to actually create, Pete, the rhetoric of the day. That's how that works.
Yeah, has anything like the Chicago Plan ever been tried in? I mean, when Lincoln created the greenbacks, that was a component. That was the debt-free money, treasury issue money piece of it, but they probably didn't have the full reserve banking piece for the banks back then, right?
Well, much worse. They didn't even have a national system of banking, so they didn't even have a way to impart a rule onto the banking system, really, Pete. So, I mean, the National Banking Act, which came also from Lincoln, was the first sense of trying to have a national system of being able to put rules down on the banks. And that, went through 20, 30 years, through 40 years of boom, bust, boom, bust, boom, bust, boom, bust, until 1907, and that crash gave us the Federal Reserve debt money system, fractional reserve debt money system. So, no, we haven't had anything like greenbacks, nor have we had anything like full reserve banking.